Hello and welcome to another episode from Not Your Money. If you're new to crypto and overwhelmed by the choice, hoping to make some healthy investments but don't really know where to put your hands and how to navigate this space, you're in the right place. This is our crypto survival kit. What we mean by that is simply a set of tools, a risk management guide to ensure you don't blow your money out of the window and keep your mental health in order. So off we go. The opportunities in crypto are utterly irresistible. Over the last 15 years, there have been tremendous investment opportunities that have attracted early investors and institutions. Even sovereign states are starting to look at this space. But with opportunity, as always, comes risk. And it's very important that we understand these well, particularly in this ecosystem. In the 15 years of life, crypto has seen all sorts of different mishaps, from exchanges going down, systems going down, cyber attacks, stable coins plummeting, bankruptcy proceedings, jail sentences. There's been really quite a lot. Let's face it, this space is really difficult to navigate, and particularly for novice investors coming into this market. The threats are multiple. Just to name a few: fraud attacks, scams, volatility, I'm sure you'll have all heard of that, liquidity constraints, obscure projects. There are tens of thousands of crypto assets. There's no wonder some of them are really quite difficult to see through and really understand what their value really is, particularly to inexperienced investors. Now let's dive in. Volatility. It's no surprise that crypto markets are tremendously volatile. But what is volatility? Volatility is simply the degree of variation of a price over time. And if you don't like volatility, well, you're in the wrong place. Stop here and look at something else. What you see in the chart are two lines, a red line and a blue line. The red line resembles cash or maybe a fixed income instrument that picks up interest yields, interest payments over time, and therefore delivers a higher rate, a higher value in nominal terms of an investment over time. The blue line goes up and down like a yo-yo. Typically, that resembles how equity markets work, or in fact, how the crypto market works for the most part. I'd say the vast majority of crypto assets belong to the blue line curve, so they can go up and down significantly, and that is an aspect we really need to master and get comfortable with. Volatility is effectively an indication of risk and uncertainty in the value of an asset. It's an indicator of a speculative asset that is subject to significant price movements. The higher the volatility, the higher the chances of dramatic changes in its price over the short time period, in either direction. That can go up or down. A lower volatility means that a security's value does not fluctuate dramatically and tends to be more steady. So where does volatility come from? First and foremost, volatility is a natural and inherent characteristic of financial markets, and it applies to those markets as much as it does to the crypto, if not more. Volatility can be influenced by various different factors, and we'll just name a few. Economic data like unemployment, GDP, and so forth. Geopolitical events like wars or pandemics may affect the price of instruments. Market sentiment, speculation, and even asset-specific news like latest developments, financials, key announcements can change the way the price behaves in the market. Just remember, though, that crypto markets are still in their infancy, and almost all crypto assets are effectively projects, startups, akin to early-stage tech stocks. As such, they are inherently risky, with very limited liquidity in some cases, and subject to significant price swings. So how do we work with it? So if you like the idea of making significant gains, you have to get comfortable with making significant losses, at least on paper. Let's not forget that you only crystallize a loss if you sell your asset. Prepare for adverse scenarios. Expect the worst to happen, and to the extent you can, do avoid panic selling. Don't sell when there's blood in the market. That's the worst possible time to sell. And if that's not for you, and you're trying to find ways to exit your position to limit your exposure, then do embrace, if you can, the use of stop losses. Stop losses are for experienced investors, or at least to a degree. And you have to keep in mind that they're not available on all platforms and exchanges. If we look at Bitcoin's historical price, well, the long-term gains have been pretty staggering. 104 million% since day one. It's easy to look at a price chart in hindsight, but there are very few investors that have been around since that time. Let's just look at those 3 red arrows on the charts, showing just how staggering the price movements have been. From almost 20,000 to just a few thousand in the first market crash, to a double sort of pullback in the last market cycle, even from a peak of $60,000+ down to just around 20,000. Are you able to sustain that type of volatility? If we just look at a more recent chart in a more compressed time period, just look at the last month. The price has been down approximately 7 to 8%. And even in that short time period, on any given day, in any given week, the price just keeps yo-yoing up and down. It's important to understand these market patterns. These movements in the market are very normal. There are all sorts of reasons that can influence these price changes, both upwards and downwards, but it's very important that you anticipate and get comfortable with these patterns and are able to sustain these sorts of swings. Research well, and research well in advance. Before investing considerably, make sure you've done the work. Like all financial markets, investments are subject to risks, and that includes risks of losses. So make sure you truly understand where you're putting your money. Do ignore improvised influences and pundits suggesting that the number always goes up. That is false. The number does not always go up. In fact, in many cases, it goes down by a lot. And if you don't understand and are still willing to make an investment, well, you only have yourself to blame in case you lose your money. There is absolutely no free lunch in financial markets, and certainly not in crypto. My recommendation would be to start with 10 hours of learning at a minimum. Start with Bitcoin, which is the first crypto asset ever created, and that will help you understand why this market exists in the first place. As you understand Bitcoin, you'll probably start understanding how blockchains work, and that will make life a bit easier as you start assessing and analyzing the rest of the crypto assets on the market. Take it from there. Learn incrementally as your investments grow. Learn to take care of your assets as you would do with all of your property and items of value. Learn how to select them. Learn to find contrarian views to challenge your own convictions. What might have looked like a sensible investment a month, a year, or 5 years ago might be very, very different today. Make sure you also learn when is the right time to sell and how to custody your assets as well. Taking time to select your investments requires careful consideration. What you see here on the screen is just a visualization of just some of the parameters to keep in mind. Do not just go for the price or the market cap. Most market data providers and most apps will typically list the assets in descending order by market cap. That's not necessarily the right indication of what a good and a bad investment is. Make sure you take the time to understand what the project is, who's behind it, where are they licensed, if at all, are they compliant with rules and regulations and so forth, what's their community like, what technology do they use, do they employ smart contracts, are they audited, and what's the health of that particular market. Finally, for instance, I really want to know who holds the private keys or who can manipulate the supply of the token. The rate of the supply, the more likely that's going to have an impact on price dynamics and dilution. These are just some of the components that may sound a bit technical, but that they should really be considered if you're likely or willing to make a sensible and sizable investment in this world. Expect losses. Prices will go up, prices will go down. If you sell at a lower price than you bought, you'll crystallize losses. Crypto investing is a high-risk investment, and at least in the short to medium term, until this market really matures and scales up to mass adoption, it is likely to remain choppy, volatile, and therefore exposing investors to crystallized losses. Invest only as much as you're prepared to lose. Start with a small allocation of your liquid assets. I'd say start with 1% and take it from there. Be aware that if you increase that sizably, then you need to make sure that you're prepared to sustain the risks you're taking. To the extent you can, try and diversify your bets. Putting all of your eggs in the same basket might not pay off in the long run. Do keep in mind that within crypto, Bitcoin is still the dominant asset. It's more than 50% on the market. And typically, as it goes up, so does the market. And if Bitcoin goes down, the market follows in that direction. Set your goals and limits early. Make sure you define your investment goals. For instance, how much risk are you willing to take? Or how much are you really willing to lose? 20%? 30%? What if you lost 50 or even 100%? How would you feel about that? You want to play out these scenarios well in advance to avoid disappointment. You should also think, what is your time horizon? When will you need that money back? What are these assets for? Are they to purchase a house in the near future? Are they for your children's education? That will define how you should be putting your money into the market and what to expect out of it. It will also help you define exit strategies, so defining price points and limits to take profits out. Be mindful of taxable events as well. In every jurisdiction, taxation looks a bit different, so make sure you speak to experts or do the research and understand what that might look like if you decide to exit, and if you crystallize a profit, just how much of that will you have to share with the tax authorities. And also, keep in mind that greed typically doesn't pay off. If you've doubled your investment or done even better than that, that's not a guarantee that will keep working that way. Eventually, markets settle down, correct themselves, and greed might work against you. So be prudent. Do not rush into investing. If you're new to this space, put the work in, take your time, understand before trading. Very, very few people in this space, even the most experienced investors, get it right in terms of finding the right price points to buy and sell. Keep in mind that unlike traditional financial markets, these markets are live 24/7, 365 days a year. So finding the time to buy and sell is practically impossible. And what are you going to do? Stay up all night and over weekends, stare at the screens until you find those moments? Our recommendation is to drip in steadily and regularly over time, instead of making one-off large investments. That way, your investment price will average out, and you won't have to worry too much about the peaks and troughs. That sort of average entry point will spread out over time. And to the extent you can, buy the dips. By that we mean keep a bit of cash on the exchanges, maybe in a stable coin, and at the right time, if the market moves against you and you are convinced about the assets in question, that might be a good opportunity to buy at a discount. Last but not least, keep an eye out on the transaction fees. The more you trade, the more you transact, the more you're going to pay out on those fees and clippings that exchanges apply to your transactions. So do make sure you understand what those fee structures look like across the various exchanges before you apply your various strategies. Avoid the fear of missing out. FOMO. If you're a novice, my suggestion is that you skip the first trade. Forget about it. The number does not always go up. And if you're following the green candles, if you're following those assets that seem to be making outrageous returns, chances are by the time you found out about it, you've lost the momentum and you're likely going to see the drop side of that investment. So take the time, take a breather, don't go into that first trade, and just take a bit of time to invest on the fundamentals. If you can't help it, make your first investment with small amounts, and only if you're really prepared to lose that. And if you're gambling your lifetime savings for an early retirement, well then, good luck. In 99.9% of cases, that strategy will not work. Stay updated. Keep in sync with the market. This space is moving incredibly fast. I'd suggest you find your crowd and your favorite sources. I love podcasts, for example, but you may find Discord, Reddit, Twitter, or X, and newsletters more informative. Find whichever platform works for you. Keep in mind that this space is really moving very fast. Trends, narratives, and use cases keep emerging and evolving and replacing one another. There are very few crypto projects that have been around for more than a few years, and there's only one that has been around for 15, and there is a reason for it. Watch out for those scams. If you stay alert and know what you're looking for, you can keep those scammers out of the way. Now, fraudsters are always chasing for your coins. They're just waiting for you to put your guard down and trying to trick you. Tread carefully and beware of what scam patterns can look like. For instance, do not click on links you don't know of, particularly those that are unsolicited that may hit your inbox or your phone. And do not ever trust investment schemes promising silly returns. Always verify the legitimacy of people and projects and platforms that you choose to interact with. If any investment offer is too good to be true, including the yield perhaps on any given asset, there's probably a catch. Stay away. Learn how to protect your assets. Think about your security early. Chances are you'll be buying your first assets on exchanges. Exchanges are not banks. Your assets are not secured. As you leave your assets on those exchanges, your assets are at risk. Stick with reputable exchanges and diversify where possible. That way you can start diversifying your bets and spreading your eggs in different baskets. At the right time, as your portfolio grows and keeps increasing in size, do consider protecting your assets with cold and wet wallets. I don't expect you to do this from the outset. It doesn't pay off to just make that kind of investment with just a few coins. But as you start raising the value of your investments, this might be an interesting option. Keeping in mind, though, that with sovereignty, that means with self-custody, you are effectively sovereign of your asset, comes, of course, responsibility. So optimize your security according to your circumstances, but do keep in mind that if you don't have your keys, you don't have your coins. If you don't own that seed phrase and those passcodes, then you don't have direct control over your assets. Make sure you understand that and fossilize that in your mindset. Manage your emotions. It's very important to keep our feelings, our emotions in check, particularly in highly volatile markets. It can be quite draining. The crypto market comes with immense risk and volatility, and your emotions will truly be battle-tested. No matter how calm you are, how much time you spend in ice baths, meditating all day, this market will test you. Prepare early to all scenarios and try and do that with a cool mind. Planning and discipline will pay off. If necessary, consult an expert in advance to anticipate extreme scenarios and play some of those out in advance. Mental health, I think, matters more than any amount of money. So, in my opinion, if the market crashes and you do still have belief in the underlying asset, then just switch off, take a walk in nature, and forget about it until the prices bounce back. Monitor your investments. Monitor the markets and review your investments regularly. Use market providers like CoinMarketCap, CoinGecko, Messari. There are plenty out there that can help you. Review your assumptions, keep an open mind, and listen out to contrarian views. Be ready to change your opinions. And adjust your strategy accordingly. If you're new to crypto, just stay away from DeFi. DeFi stands for decentralized finance, and typically it gives you access to all sorts of opportunities with high yielding returns, and with those come high risks, not just financial risks, but also hacks and other type of technological threats, which I think for now you may want to stay away from. Earn your white and yellow belts before heading for the red and black belts. Perhaps once you've got a bit of experience behind you, come back later and check it out again. I hope you found this session useful. If you want to embrace crypto assets with confidence, make sure you understand the risks you're up against. Thank you very much, and see you next time.